All right, everybody, real quick before we get into this, I'm working really hard to grow the Options Education Channel's YouTube page. So if you found this content valuable, I appreciate it if you would like and subscribe so that you don't miss content. All right, everybody, welcome back. So on the chart right now, we've got Amazon, and as promised in the previous video, in this one, we're going to discuss how the volatility is a manipulated product while we're coming into an earnings event, and that the ramp you see and the increased implied volatility that you see as we come into earnings isn't a real volatility. It's not the volatility that you think it is. It's not the normal one that you expect to use. And it's not even the surprise one that we get like when we had the virus back in February. The earnings volatility is elevated for a very particular reason. They want to hold the expected move as steady as possible, and they actually can decrease the expected move while increasing the implied volatility. Now, one of the reasons that they do this is to try to hold the expected move as still as they can. But another reason that they do it is to change the value of the options. All right, so during an earnings event, we know that there is surprises, that the market can really make a move, and they're trying to dial back the expectation of that movement, trying to hold back the breakout or the whiplash that could follow from a bad earnings announcement. We'll take a look at Intel for an example of a recent bad earnings announcement. So it had to kind of zoom in a little bit to see it, but earnings went from $54 as it went into the close, reported its earnings, and it opened the next day at $48, and then stabilized and fell and is now trying to hold the line at this new price. All right, so when we're calculating how far a market is expected to move by looking at the options that are traded as we're coming into an earnings announcement, we can get an idea of where we believe other traders think the market is going. Their actions in what they trade give us an understanding of how far the overall market expects the market to move during earnings. Whew, that's a lot of different markets. All right, but we can see that manipulation. We can actually go in and recreate the events as we came into earnings and look exactly at what happened to the implied volatility and to the expected move. And this is where the proof lies to show you this is not something that you want to put on where you think you can put on a credit spread and slowly over the next couple of weeks watch it decay because it has, quote, high volatility. All right, so to do this, we're going to go to the Think Back tab. So here we are on the Think Back tab, and we can see where the earnings announcement is. Notice how the implied volatility is 25, 23, 23, 23, and then it jumps way up to 29. That's a really big warning that, hey, there's something there on that day, and the market makers are pricing something in. If we weren't sure that that's where the implied volatility was aiming for earnings, we could just go look. Is there earnings that week in January? Yes, there are. Okay, so we know now that there's earnings on, what day is that? The 22nd on Intel. We don't want Intel, we want Amazon. So let's go over to Amazon. And we go to the first earnings in January, and we can see it's on the 29th. Great. Okay, so they actually reported on the 30th. Friday of that month is when the options are going to expire. So we will look at the January 31 options. Notice in the upper right corner, it's January 2nd, 2020. So we are 29 days from expiration at this point. And we can see 29 days away from earnings, Amazon has an implied volatility of 29.43%. And it gives an expected move of $126. Now we're going to go forward in time 1 week from the 2nd to the 9th. So here we are, it's the 9th. We are 22 days away from expiration. And we can see that the implied volatility has gone up. It's at a 30.71, but the expected move went down. It's at 115.50. Well, that's not normal. That's not the way it's supposed to go. Normally, when implied volatility goes up, it causes the expected move to go up. It expands the expected move. So let's jump forward another week in time. And now we're going to go from the 9th to the 15th. Now, why did I choose the 15th? Well, I started on the 2nd because that was the day that the market was open. And we went forward a week. But we want to be in line with the 29th because that's where the earnings is. So we stepped over 1 day less than the full 7 days. So we're 15th, and on the 15th, we have 16 days to expiration. And with 16 days left to expiration, we have an implied volatility of 32% with an expected move of $100.97. That's not normal. When implied volatility goes up, so does the expected move. That's the way it's supposed to work. But we can clearly see right now that as we approach earnings, that's not what is really happening. Let's go forward another week in time. So now here we are, 9 days before expiration. We've got an implied volatility of 37.82. Remember, we started at 29, and now we're all the way up to 37. And we still have a smaller expected move. All right? Let's go forward one more from the 22nd to the 28th. Now, why the 28th? Well, earnings is on the 29th, so we don't want to use that. It would crush, right? So here we are 1 day before expiration. We've got an implied volatility of 50%. 50% implied volatility. 3 days to expiration. And we have an expected move of $71. So we not only went up 13% in implied volatility, we dropped $20 in expected move. Because the options are being manipulated at this point, that implied volatility is not real. And because it's not real, it's shunted, it's manipulated. They're trying to hold that expected move still. And what they end up doing is shrinking the expected move. This is proof that these implied volatility levels are not to be used the way that we would use a regular high implied volatility marketplace. It is a good idea to find higher implied volatility products and then sell the credit. That is true. Options expire. They decay. All right? So an option that you find for $10 has a lot of extrinsic value in it. And as time goes by, that extrinsic value or that time value is going to go down. So the price of that option is going to go lower and lower and lower until the day of expiration when there's just no value left. So if you're the one that sold it and you buy it back when it's worth 1 penny, you get to keep all the money that you collected, except for that penny that you used to buy it back. But when it's an earnings implied volatility, you're stuck in that option spread because those options are not decaying the way that they're supposed to, and you're going to be in it all the way up until they expire, waiting and waiting and waiting for those options to decay in value. They will finally decay in value. On the day of expiration, they will very swiftly start to dump. Do not believe for a moment that you could just run in on the day of expiration and sell them, wait for them to crush through the day, and then buying back at the end of the day. Your pricing model isn't going to work for that, right? So that's not going to be an effective strategy either. However, for earnings, what we typically do for earnings is on the day that they're going to report, let's say they report in the afternoon, all right? So when the market closes, Amazon at close has earnings. And I honestly don't know. It could be a morning report, afternoon. We're just going to say it's in the afternoon. So at the close, it has earnings. What we would do is somewhere around 1:30 in the afternoon, we would go and put on an iron condor. Remember, an iron condor really is just 2 credit spreads. The next day, after it has reported that night, the next day when the market opens, the volatility is going to be crushed out of those options. And when that happens, what you sold for perhaps $4 is now worth 75 cents. You buy it back, and yay, you're the winner, right? That is a typical, normal, everyday earnings trade. But you are literally putting on a trade in the most risky situation that you could imagine, because there's absolutely no telling what's going to happen when it reports. Now, what you want to see happen is something like this. It reports, and say the expected move was expected to be this big. It makes its report. It never leaves the range of your iron condor, and the next day you get to buy it back way cheaper than you sold it, and you're the winner. What you don't want to see happen is a major gap way outside the boundaries of the expected move, and then watch it run away and not go anywhere. Just run away, and you never get a chance to close. That is the danger. So if you're looking to put on an earnings trade, look back in the history and find out, does it have a history of breaking the expected move? And if it does have that history of breaking the expected move, find out if it has a history of breaking it and coming back, or if it has a history of breaking it and continuing to run. I'll give you an example of what you don't want to see. Let's go look at Target. So Target was going through this volatility period, and it would have these amazing moves at earnings, and it would not come back. And once it happens, other people decide, people who are trading directionally, they decide, oh man, that was a really good trade. I'm going to do that again. So they do it again, and then they do it again, and that gap gets bigger and bigger and bigger because more and more people want to participate in that kind of move. Those are the gamblers. Those are the people that want to take the big risks, the casino players. This is what you don't want to see. With an iron condor, you want price to whip around a little bit and then settle right back to its normal. If you look on the chart and you see a bunch of these gaps at earnings where it made a massive move and didn't come home, avoid that at earnings. You don't want anything to do with that. Okay? Notice on this earnings, things got very volatile, and then it just settled right back in again. That's what you want to see. That's what most markets do. Over 4,000 markets report earnings. Most of them you never hear about. They're boring. They don't even move, right? Like Goldman Sachs. Goldman Sachs has a history of boring earnings. It's exactly what you want to see. Nothing. You want it to be boring. You want it to have nothing. But also notice there's not much ramp on Goldman Sachs either. From earnings to earnings, sure, it gets a little bit of a volatility crush, but nothing major. Because it's a boring stock that doesn't typically have unusual earnings announcements. So it reports, it does nothing. Yeah, no big deal. We make our iron condor and we move on. So don't go looking for these high fly, highly public, highly controversial companies that make big moves at earnings. That's not what you want for the iron condor play. You want those boring ones that don't do anything. And yes, they're going to have a lower payout because, they're not expected to move. No risk, no reward. But I will take a lower reward if I have an increased chance of winning. Guys, I appreciate your time. I look forward to seeing you at the next video.